One lesson for all of us is when we make investments, there is this simple concept called portfolio, meaning don't put all your money into one investment option. If you are interested in stocks, don't put everything in stocks. If you are interested in real estate, don't put everything in real estate. If you're interested in gold, don't put everything in gold. You need to figure out how do you spread your portfolio, because that is what helps you stay away from certain aspects of risk. See, stock market could suddenly crash, and if all your money is there, you're stuck and you're waiting for it to turn around, and it could take few months or years sometime. Real estate has been growing, definitely yes, depending on where you're investing in the country, has been growing. But what if one fine day there is a fall? And we have seen several instances of real estate fall along with the economic depression. What I'm trying to tell you is it's important for us to gain awareness of these things, especially understand what is risk, and then decide for our own self what is the investment plan for us. Okay, so invest early. One tip here is invest early. Investment is not for retired professionals. So young people may think, I can now blow my cash, I can consider investment later. Never do that. If you invest early, I will tell you the benefits that you reap out of the early investments is substantial. Take real estates, take golds, take mutual funds, or take stocks. If you invest early, by the time you are in your middle age or in your later age, the amount that investment grows is substantial than when you start in your middle age or in your late age. So, and we are in a growing economy. Even today, I think all of us have a great opportunity to invest and invest early. When you look at investment, these are the things that we need to look at. What is the risk? What is the yield? Yield is nothing but the return. So there are certain investments where the risk is low, yield is also low. There are certain investments where the risk is high, but yield is also high. They do say risk and reward go together. Not necessarily. There could be some cases where the risk is high, but the return is low, and vice versa. So we need to trade what is the amount of risk. So here there is a chart which shows the least risk all the way up to some high risk items, and then some high return items with low risk, etc. So for example, dividend paying stocks that are able to pay dividends, stocks that are from companies that are being managed well, run well, profitable. The yield is fairly high and the risk is moderate or lower. Whereas some high yield bonds, the risk is very high. Return may be high, but the risk is also very high. So we need to very clearly understand risk and return, and then also figure out what is the thing for me. For every individual, the risk and return mapping has to take place. It has to be a customized risk analysis and decision making. Again, I'm taking another example of a great celebrity who had a small investment risk. Overall, he managed his investments really well. I'm sure we all must have heard of this movie Ravan. Does anyone know what was the budget on that movie? They spent about 150 crores on that movie. Red Chilli's production, 150 crores, and it failed. If it was somebody else, a 150 crore loss or 150 crores investment that is net loss is a huge impact on somebody. So one lesson for all of us is when we make investments, there is this simple concept called portfolio, meaning don't put all your money into one investment option. If you are interested in stocks, don't put everything in stocks. If you are interested in real estate, don't put everything in real estate. If you're interested in gold, don't put everything in gold. You need to figure out how do you spread your portfolio, because that is what helps you stay away from certain aspects of risk. See, stock market could suddenly crash, and if all your money is there, you're stuck and you're waiting for it to turn around, and it could take few months or years sometime. Real estate has been growing, definitely yes, depending on where you're investing in the country, has been growing. But what if one fine day there is a fall, and we have seen several instances of real estate fall along with the economic depression. So there's that old saying, don't put all your eggs in one basket. That is the simple fundamental that we need to follow when it comes to our investments. Look at SRK in terms of where he puts his money. We all know he's earning his money through movies for the most part, and then some TV shows, and then some brand endorsements, etc. But look at his investments. He spread them across. There's a production company where he has invested some money in Byju's. Byju's is there in the news for wrong reasons. He has a cricket team, Kidzania, and there are many other investments that he made in real estate, etc. So even some of the wealthiest people, they know of all the options that they have. There's one option that gives the best return, but it is never good to put every penny into that. It's always good to spread your investments across different investment opportunities. And he is a grand example of how he has done that. Despite that Ravan loss, I think he was able to quickly move on. Debt management, just I'll try to tell you one fundamental principle when it comes to debt. Debt means you're taking a loan. I have seen many small business owners, I'm repeating, small business owners, who do not easily get hold of finances, who do not get a bank loan because there is nothing much to have as mortgage, who don't have enough money of their own. Friends and family may lend them but small amounts, and that's not sufficient. So what small businesses tend to do is they go to high interest financiers, 3% a month, 4% a month, or whatever. And some of them use credit cards to manage their cash flows in the short term. The simple fundamental rule when it comes to debt is never borrow at a rate of interest if you're not earning more than that rate of interest. If you're borrowing at 3% per month, it's about 36% per annum. And if your business is not giving you 36% return on that investment, it means that you don't have money to service your debt. And then you get into this trap. In order to pay the interest, you have to take one more loan, and there's more interest, and it goes on. So typical debt trap situation. So however positive we are about our business, always trade whether you are getting money at the interest rate. I would rather say, and maybe I'm a bit conservative, I would rather say if you are borrowing for any business or any investment which has a fair amount of risk and you're not covered fairly, don't borrow at a high interest rate and be very optimistic and picking it up. If you have that risk capability, nothing like it. But otherwise, you end up with one bad situation. Like we have seen a number of people struggle during COVID, a number of small businesses, despite very good finance management fundamentals. So with businesses, there is always this thing of an uncertainty. And when you have an uncertainty in your business, you have to be very, very careful. The more uncertainty in your business, the more careful you have to be with how much amount of debt you are going to bring into your business. Dangers of accumulating debt and living beyond means. This is another thing that I'm noticing in young people. Borrowing to run a business is one thing. Borrowing to spend for ourselves, especially not on needs, but on wants and luxuries. That is becoming a trend. That is a huge risk all of us are taking. Never borrow money to spend unless you have cash flow coming out, which is in the pipeline or whatever, but never ever borrow money to spend. If you are borrowing, it has to be for investment, and that investment at any cost has to generate better interest rate than the rate of interest that you are paying on the debt. We always think that individuals are only going to struggle with managing finances, but just some examples of companies also get to these situations. All of these or some of these may look like scandals. Okay, there is a scandal element in it, there is no doubt about it. But the fundamental problem that most of these people had is not a proper way of managing their finances. The ill intent, let us keep it aside. The fraudulent activity, let us keep it aside. But first they reached that situation in most of the cases when they could not manage their own finances well. And each one of them have a lesson to learn. I just put them up for you to look at these as case studies to understand how corporates manage their finances or corporates fail to manage their finances. Satyam has a great lesson in terms of governance issues. Sahara has some great lessons in terms of what are regulated financial products, what are non-regulated financial products. We need to look at Sahara's case very carefully, because many times we get tempted with such options. Companies coming out and saying that I'm going to pay you substantial rate of interest if you put money with me. We have to look at fundamental thought process of how are they generating that money. If somebody is promising you 3%, 4% rate per month, how are they generating that 3%, 4%? Understand their business before you. Sahara is a great example of thousands or lakhs of people who have got into losses by investing in their financial product. That's not so one for anybody to put money. ILFS also has some lessons for us. Yes Bank has some lessons, but Yes Bank, I think, has made a good turnaround from whatever struggle they had. I think we need to always consider insurance plans for different aspects of our life and business. Life, especially medical health, there are increasing number of cases where there is insufficient health insurance, and health is again an uncertain thing today. Somebody gets severely ill at home, lifetime savings of the family are getting spent in the hospital. Yeah, I think we land up in a situation where our lifetime savings have to be spent in recovering the health of an individual, just because we did not have medical insurance or enough medical insurance. I mean, there's no limit to how much you can insure, but I think at least a reasonable amount of insurance we should all have, and look at all the different things for which aspects of life for which we need to have insurance: health, life insurance, automobile insurance, home insurance, loans insurance, if you will, so on and so forth. Insurance and taxes also should be understood by everybody. We may assume that financial literacy is for professionals who are closer to finance fields. No, we all deal with money every day. We all have income, we all have expenses, we all buy assets, and we all take loans, or we have some sorts of liabilities, or one of the four at least. So it is important that we all have to understand some basics of finance. We have the financial literacy for us to manage, and it is what I still fail to understand. Why is it not part of the school syllabus? As much as we teach kids how to cross a road, what is green light and red light, I think it is important to understand financial literacy as well. Taxes is another area. Learn fundamental aspects of taxes. There are opportunities. So for example, if you're a consultant and you generate consultancy fees, I see a good number of people filing a tax return, considering it as a profit or loss in business, or filing a return it as a salary. But there is an opportunity in income tax to file a return, section 44AB it's called, where you file a return as consultant, and you're likely to pay much lower taxes than what you're supposed to. There is one famous example. Again, I'm bringing in a celebrity so that it sticks with you for longer. Sushmita Sen, the Miss World 94, if I got the year. She had once a situation where she was asked to pay a huge income tax, and it's whether her understanding or her team's understanding. At the end of the day, they fought the legal case with the income tax department. They got their rules, and they were able to do away from paying heavy taxes. So it's important to get a basic understanding of income tax. Often we get questions around, what do I do? I have a property I sold. What do I do? How do I declare? Should I take cash? Should I not take cash? Again, one fundamental assumption most people make is accountants are born to convert black money to white money. So never be into that assumption. So I always struggle when people come to us with those questions. How do I avoid taxes? I'm not asking you